to you, Jay, and to all the colleagues who are listening. Um, First of all, I want to thank the CKC management for giving me this opportunity to talk to you about this topic, which is of great interest to me, and I think of great interest to Africa and its development partners. We're going to talk about capital flight in the context of financing African development. And just to give a context, as you know, in the current policy debate, there is a large interest. Oh, sorry, what did I do? Did I do anything? No. There is heightened interest in both the donor side and the recipient side to actually ensure that all the aid that goes to Africa and other developing countries alike are actually, this aid is used effectively, that it generates results, because aid needs to be financed from the donor side. That involves budgetary allocations, and from the recipient side, there is also increasing pressure from the public to actually see that governments are accountable as to how they manage aid received from abroad. And this is likely to increase as we see more what I call democratic awakening. You all have witnessed the events in North Africa, what has been referred to as the Arab Spring, where the youth basically took over the government. I was there, witnessed it, but that was an illustration of how economic deprivation, lack of economic participation, economic empowerment can actually have deep social and political implications. So it also demonstrates the fact that eventually the people will have a way of demanding accountability to the government. If it's not through democratic, if there is no democratic space for demanding that accountability, unfortunately, this pressure takes violent roots. At the same time, we have seen a rising volumes of aid to developing countries in general and Africa in particular. People have pointed to increasing aid per capita. Some countries, of course, receive more aid than others, but it is still the case that the delivery of aid still falls short of both the needs of Africa and also the promises and the pledges. Here I give you an example. Many advanced countries have committed to reaching a target of 0.7% of gross national income in aid budget, but only 5 countries now have reached that target. But also, when we look at the various pledges that have been made by developed countries, including say the Glenagle pledges, they have been under dispersed. So there is this increasing volume of aid should be seen in the context of under delivery based on the needs and also the pledged volumes of aid. So this graph shows you what I was pointing at, which shows that from 2000 we see an increase in aid, and that sub-Saharan Africa, the red line towards the top, has seen a large increase in aid per capita. But also, if you look at sub-Saharan Africa as its share in total aid to all developing countries is quite substantial, about 44%. But that you have to understand that Africa also hosts the largest number of least developed countries. LDC is least developed countries. So it's natural that the continent will also get a larger share of total aid. But even as we see rising volumes of aid, Africa is still facing large and growing financial gaps in key sectors such as infrastructure, social services, education, and health. If when you walk around the continent, you'll see that there is increasing pressure on education infrastructure, larger and larger numbers of kids in school. Countries have tried to do what they call a double rotation of where they have one group coming in the morning, another group coming in the afternoon. But that means a lot of pressure on the teachers. You see health facilities with very little supplies, even as demand increases. So African countries are both pushed to demonstrate more results of aid, but at the same time, this volume of aid is not enough based on the needs. Just to give you an illustration, when you look at the infrastructure alone, these are figures for 2008 from the African Development Bank and the World Bank. Africa would need to invest about 93 billion per year in infrastructure, including power, water, transport, ICT, and irrigation. Today, currently, only 45 billion are invested, leaving a gap of 48 billion. And the biggest gap is in the power sector. We are fortunate that we are doing this webinar here. If we were doing it in many of the African countries, we will not finish before we get cut off by power outage. So, and you can't. This has severe implications on what countries can do in terms of promoting private sector investment, agro-businesses. Because of lack of power, all these activities become difficult to implement or become too costly. That's why you'll find that in many African cities, firms have to rely on private power generators, which are very expensive, and leave alone how they are polluting the environment. So it's a very, very inefficient way of providing power to industry and manufacturing. So lack of financing, low volumes of financing, even though they are increasing, they still leave we still leave large gaps of unfunded investment in needs, programs in in the social sector, education, health, and so on. And I haven't even talked about the demands for climate change mitigation and adaptation, which is an emerging global need, where Africa is also called to invest more in that area. But then they are not even meeting the basic needs. So how are they going to scale up investment in climate change mitigation and adaptation if they don't even have enough funding for schools and education and health? But at the same time, where our research shows that Africa has been transferring a large amount of resources outside in the form of capital flight. What we mean by capital flight is unrecorded movements of capital across borders, which gives discrepancies between recorded sources of foreign exchange and recorded users of foreign exchange. The biggest foreign exchange inflows come in the form of debt and foreign direct investment, which is used to cover the current account deficit, the gaps between export revenue, import revenue, and the difference will be added to reserves. But in many countries, so if all the capital movement is recorded properly, we would see that once you have taken the inflows, accounted for the use of the current account deficit and net reserve additions, you would have no major difference. But in many countries, we do find huge discrepancies, and we take this as evidence of capital flight. Capital flight occurs through many mechanisms, but the biggest ones are what I was describing here: the leakages between in the balance of payment transactions, where inflows are not traced back. So an example would be a country borrows 100 million, and for different projects, a fraction of it gets siphoned out by government officials who are entrusted to manage these loans. So you'll never see it in the form of users. It will be stashed in private accounts abroad. So that's one of the form of leakage of resources outside of the country. But also we find that another mechanism for capital flight is in the manipulation of trade invoices. And here an example is an exporter in an African country exports for 100 million or worth of goods and services, and declares only 80 million to the central bank, to which he has to remit the foreign currency in exchange for domestic currencies. Of course, this is made possible by complicity of the trading partners who are willing and ready to supply fake invoices that show 80 million when actually the goods sold were 100 million. On the import side, the importer, an African importer, will have the incentives of declaring an inflated value of the import. So they are importing for 50 million. They declare that the imports are costing them 60 million. That is the amount of foreign exchange they are going to request from the banks, and the difference is going to be stashed abroad for their own use to pay for their luxuries, travel, health needs, and even smuggled imports. We also find that there are missing flows in the worker remittances, and worker remittances are important because it's a growing source of inflows in African countries. In some countries, it's exceeding. The volume of remittances exceeds foreign direct investment and even aid, and we believe that the remittances are very severely underreported. In some countries, we find that, I'll give you an example. In Ethiopia, the Ethiopian Central Bank reports about twice the amount of the remittances reported in the World Bank data, and even the 600 million reported by the central bank is viewed as an underestimate based on the stock of Ethiopian migrants in the diaspora. The correct figure would people believe would be around a billion. Capital flight is illicit. It is illicit in the sense that at the origin, capital flight, these outflows which go out hidden, which are not declared at the government authorities, most of the time involved money that was acquired illegally through corruption, embezzlement of government resources, traffic of drugs and humans, and trade mispricing. But also, capital flight is illicit in the sense that it is transferred abroad and not properly recorded with the national authorities. So it's already breaking the law by failing to report these flows to the government authorities. But also, there is a scene of hidden foreign holding when the holders of these assets do not declare them to the national authorities. There is nothing that prevents anyone from investing abroad. It's a natural part of portfolio management. But when anybody does so, they are supposed to declare the transfer and the proceeds to the national authorities for recording, tax purposes, and so on. So when these assets are stashed in foreign bank accounts in the form of real estate and not declared to government, we consider that this is illicit. The transfer of funds abroad in these illicit forms is facilitated by what we refer to as safe havens, which are territories, jurisdictions, nationalities, cities, and so on, where banks and other financial institutions provide a cover to illicit transactions on the back or on the grounds of banking secrecy. Banks will argue that they have the responsibility to protect the identity of, the interest of their customers, but that doesn't have to mean helping the customers breaking the law. In fact, if you look at the laws on the books on all countries, developed countries and developing countries, there are rules that require banks to declare and to report suspicious operations. Really, if somebody shows up in your door and you are a bank with 500,000 cash, you have to ask, where is this money coming from? That is a suspicious operation, but many times it is evident that this is not done by the bank, which means the banks are not enforcing their own the rules on the books. So that facilitates the transfer of illicit assets, the holding of illicit money abroad by African private operators and government officials alike. We have been able to compute capital flight for 33 sub-Saharan African countries. Soon we will be releasing an update of these figures and even expanding it to North African countries. So the figures will be much higher than what you see here. We have looked at the period from 1970 to 2008, and what we see here is, in terms of the volume of capital that has fled African countries in real terms. That means that we measure capital flight from all the years in terms of 2008 dollars, US dollars. That's the second column, which says real capital flight. So in 2008, these countries had lost about 735 billion. If we assume that the flows of capital that has left the country, the amount of money that has left, had been invested at a very minimum nominal interest rate of the measure that the treasury bill rate, that capital would have accumulated to what we call here the stock of capital, 944 billion. These amounts are very big. If you consider them, compare them to other measures of, say, the size of the sub-Saharan African economies, in 2008, all sub-Saharan African economies had a size of 1.1 trillion. So not far from the size of the stock of capital flight, but also compare it to asset held by wealth held by Africans, private Africans, which are categorized in the club of what Merrill Lynch calls high net worth individuals. These are individuals who have investable liquid assets of 1 million at least. For Africa, this club of wealthy people have about 800 billion in 2008. Today it's a little bit higher. And unlike other regions, the reports by Merrill Lynch and other researchers tend to show that, unlike other regions, African wealthy people tend to hold their assets abroad, whereas by and large, Americans, Europeans, Canadians, Asians keep their wealth, most of their wealth, in the same continent. So which means that Africa is being robbed twice. They get the funds are transferred abroad, not recorded, so they don't yield any taxes. But secondly, these are investments which don't produce any jobs, any additional benefits to the economies. We find that this volume of capital flight is much higher than what African countries have been able to receive in the form of aid. For example, for the same 33 countries over the period of 1970 to 2008, they received about 687 billion, much less than the capital that fled out of the continent. Another interesting measure had been telling you about infrastructure gaps in Africa. looking again about the same estimate by the World Bank and the African Development Bank, for Africa needs about 93 billion dollars to invest in infrastructure. That's about 930 billion in 10 years. That's that's almost exactly the same as the stock of capital flight from these countries. So these countries could have been able to bridge the infrastructure gap with if they had been able to keep their assets onshore. So the fact that African countries face large financing gap can be solved if not only African countries raise more revenue, but also, most importantly, manage to keep their revenue onshore. We hear a lot about African countries being severely indebted, which is correct if you look at all measures of debt. So here I show you the fact that over time, the stock of debt has been accumulating in African countries. That's the blue line on the top, but it has declined since the end of the 90s. This is the debt relief initiative. But what is more interesting here on this graph is that on net basis, if you take the amount of money that African countries were getting in the form of new debt, take out the amount of money that these countries were sending out as debt payments, that's the purple line, which called the net debt transfers. In many years, first of all, that amount was very, very low compared to the sum of debt. In many years, this difference was actually negative, which means that African countries were transferring more money abroad in the form as they were borrowing than they were receiving. So say, for example, from 1994 all the way to 2004, this difference was negative. So Africa was financing the rest of the world. The red line is capital flight, and you can see that in the over the last decade, capital flight has been rising. More money has been going out of the continent, and this is the period which saw boom of in commodities. So commodity-rich countries have been have seen an explosion of their exports, but it appears that some of the money never came to Africa, or actually maybe had cycled out of the continent. In the report that we hope to release soon, we will actually confirm the fact that the oil-rich countries seem to be the most exposed to this problem of capital flight, and which would partly explain why we haven't seen proportional development outcomes in those countries. So, contrary to the perception that Africa is heavily indebted, severely indebted, the continent is actually a net creditor to the rest of the world, because in 2008, again looking at the 33 countries, these countries owed 177 billion, but these countries had 944 billion stashed abroad in form of capital flight. So they could wipe out their debt by repatriating just a small amount of the capital flight. Also, we hear that Africa is aid dependent, has received a lot of aid. It will be actually interesting to do a survey and ask the public whether Africa has received lots of aid, too much aid, not enough aid. You will hear many people telling you that Africa has received too much aid, so that when African countries or other or their partners request for more aid, there are people who say that Africa doesn't need more aid, they have received a lot of aid. It's actually not true. First of all, I told you the aid doesn't really measure to the amount of needs that these countries have. But here what I'm showing you is that, in fact, Africa would not have needed aid, would not need aid if they could keep their money at home. For those 33 countries that we looked at in this report, from 1970 to 2008, they received 687 billion. They sent out of the continent 735 billion. So If they could keep their money, they would not need aid. And in fact, if they did receive aid, by keeping more money, they would generate much higher growth, much higher development outcomes. In our analysis, what we find is that there is what we call a revolving door. This is a nice door you see here, where money arguably lent to Africa actually ends up back in the same banks abroad where the money was issued, but this time in the hands of African private bureaucrats who have embezzled the money. So we find that external borrowing fuels capital flight. The same money that's borrowed by African countries actually ends up financing private wealth accumulation by the leaders, by corrupt leaders. We estimate that over half of each dollar borrowed every year cycles back out of capital flight. So when we look at the flows of debt and the flows of capital, we find that a dollar borrowed in a year, out of a dollar borrowed in a year, about 50 cents goes into outside as capital flight. And this revolving door is facilitated by banking secrecy in safe havens, because again, the bankers collude with corrupt leaders to hide these illicit transactions. So, which means that some of the debt that has been borrowed by African countries did not benefit the people, and actually could be challenged in terms of legitimacy. So we argue that some of the debts are odious. Odious debts are those debts that did not benefit the people but were pocketed by the rulers with the complicity of their bankers. Odious debts in the literature, in political science literature, has been defined as debts which were borrowed without the consent of the people, which means that a government official was borrowed or a government borrowed the money without going through the approvals by, say, parliament or any other elected body that represents the people, and it did not benefit the people in the sense that the money did not finance projects, development projects, health, education, infrastructure, but was instead pocketed by corrupt leaders. And the lenders knew or should have known of these facts. Why should they have known? In normal lending practices, when a bank lends money to a government, first of all, there is a long process of due diligence which evaluates the validity of the proposal, what projects are going to be financed, whether there are mechanisms in place to ensure that the project will be run effectively. And then after the money is issued, there are processes of reporting, monitoring that ensure that money that's being dispersed is actually financing the project. So that's normal business practice. So if money disappears, somebody in the bank should have seen that there is no road being built. If that doesn't happen, it is the responsibility of the lender, and therefore it's not the responsibility of the African people to pay back the loans, which never benefited them. Capital flight is a severe development issue. It undermines resource mobilization because it reduces domestic investment, which means that reduces the tax base, but also directly reduces government revenue that could be allocated to public investment and social service delivery. But beyond public development financing, there are political economy implications. Capital flight deepens inequality because the beneficiaries of capital, or the culprits of capital flight, are the elite. They are the elite, the political elite and economic elite. And these are the same people who are responsible for policies such as social service delivery. Now, in corrupt regimes like those, wealthy elites, wealthy politicians do not rely on national public schools, public health clinics. They send their kids to school in private schools in the country or private schools abroad. So you have a very corrosive incentive system where the same people who are entrusted to provide public services are robbing the country, but are not are not paying the cost of shortage of services, which then perpetuates this corrosive environment. But also, capital flight strengthens corrupt regimes in the sense that they accumulate the wealth, they accumulate the money that allows them to buy, to erect the repressive machinery to protect them from pressure from the population. Sorry, here the text is overlapping with the top one, but it reads: not combating capital flight, tax evasion, tax avoidance will benefit not only African countries but also the United States and other advanced economies, because this will help establish a more transparent and accountable international financial system. Because, as I said, what facilitates capital flight is the opacity of the financial system in offshore financial centers abroad. But that also has negative effects on, say, the US, the Europe, and so on, because the same centers help hide money that's transferred from the US. So the US also, it may be losing tax revenue from capital that's touched in safe havens. So if developed countries and developing countries can join hands in cleaning up the global financial system, it has benefits to both developed and developing countries. So what can be done? Of course, African countries have to make effort to fight corruption, because the sources of illicit financial flows is really corrupt practices. But also at the same time, one can make an argument that there are private investors who don't feel comfortable investing domestically because of the insecurity, uncertainty, high business operation costs. So those are reforms that need to be undertaken to encourage private Africans to invest in Africa. But also at the same time, African governments needs to improve the management of borrowed loans. We propose that there should be systematic debt audits to establish the legitimacy of debt and the allocation of debt. And once debts are established to be odious, they should be repudiated. So this sentence should read: repudiation of odious debts. But at the global level and from the donor side, these efforts by African countries have to be supported by the efforts from the developed countries, Africa's development partners, who should enforce responsible lending and borrowing practices. The United Nations is promoting new norms and about lending and borrowing. The United Nations Commission on Trade and Development, UNCTAD, is working on new proposals. They were presented in Doha at their last conference. They are a very good step in the right direction, which really will help increase transparency in the banking sector, and also utilize better the new legislations that exist in developed countries, especially in the US, against corrupt practices by corporations, against tax evasion, against money laundering. So I think that there is goodwill on the part of, I would say, strong goodwill on the part of developed country governments to really help reduce the impact of private sector corruption, corporate corruption, because everybody understands that this undermines the efforts of both developing countries' governments, but also it actually has negative impact on the well-being of populations in the US. Less taxes paid on capital that's stashed abroad in safe havens means less public service delivery in the US. We also propose that on the donor side, other countries should join Norway. Norway has just recently approved, the parliament has just approved a new process of auditing Norwegians' debts that have been lent to developing countries systematically, transparently. I think this is a unique opportunity for other countries to jump on the bandwagon, because it will really help shed light on where does the money go, what is being financed by the money that goes to African countries. I thank you all for your attention, and I will be happy to entertain some questions.
Great. Thank you, Dr. Ndikumana. We do have a few questions that have been coming in. I've got some by email and some in the chat box, and I encourage everybody to use the chat box. If you don't have the chat capability, you can go ahead and email me at speakers@culturalknowledge.org. So the first question is, what has been the net effect or the real impact of the Millennium Project in terms of forgiving of debt?
Thank you. As I pointed out, the debt forgiveness initiative, which started in the second half of the 90s, and we started seeing the benefits in the implementation towards the end, 97, 98, and so on, has had some visible impact in reducing the debt burden on African countries. And this, as you know, was premised on the view that on the idea that African countries, once they are relieved of the debt service, they would allocate more money on social service delivery. In fact, so we have seen, first of all, a reduction of debt payments among those countries because the stock of debt had reduced, and we have been seen some improvement in social service expenditures. But at the same time, demand for social services, because demand for social services has been increasing so fast with the demographics are just such that the demand increases every year. We have young populations. Enrollment in demand for school enrollment keep rising. So the reduction in debt service, which increased fiscal space for the government, helped increasing social service expenditures, but that was not enough, and that's why we still see these shortages in social service delivery. So it was a welcome initiative. The concern now is for those countries that benefited from debt relief, the concern is that they may actually cycle back into debt distress by accumulating more debt. So this is something that's on the radar screen by governments, the development finance institutions, to make sure that the countries that have overcome the debt trap do not go back into debt distress.
Thank you. We have another question here. You say that with odious debts, lenders can be responsible. Does this mean that the World Bank, USAID, and the IMF are culpable? And I imagine the implication is what actions can be taken if so. Sir, did you get that last question?
Sorry, I forgot to put on my mic. The question was about odious debt. Yes, so I was saying that when a country enters into a debt contract with the lender, there are binding commitments from the donor and from the lender side. From the lender side, the commitment is to do what we call due diligence before the loan is issued, to make sure that there is a bona fide project that's going to be financed. There are mechanisms that will ensure that the loan that is going to be dispersed is going to be used effectively. I, for sure, was for 3 years working for the African Development Bank. That's the procedure that is followed by at the African Development Bank, and I'm sure it's the same for at the World Bank and so on. In fact, the loans first of all have to be requested by the countries, and the bank goes along processes of verifying that there is a road that's being going to be established. It's going to be, how it is going to be cost, which unit in the government is going to run the to implement the project. So on the books and in terms of mechanism and procedures, there are procedures that would ensure that the money actually goes into the project that's being financed, which is why if there is if there was evidence that money that was issued to a country disappeared, the lender would also be responsible if they had not noticed that or reported that, because there are, even after the loan is issued, there are reports, monitoring reports that are filed by the lender on a regular basis until the project is completed. And that's why we insist that there should be a transparent debt audit, because you can't claim that money has disappeared unless you have the evidence. Okay, even when you say this government is corrupt, you can't claim that the money has disappeared. You have to have the evidence that money was issued, but there is no project that visibly can be attributed to the loan. So really, debt audit is essential in this process. Otherwise, it will be the claims cannot be documented.
Okay, here's another question. What percentage of offshored capital is actually held by corrupt bureaucrats rather than the individuals who earn this capital, and just they don't see it as profitable investment for themselves within their own countries? I mean, is it really capital flight, or is it just they're holding on to it within their own countries?
Thank you very much. First of all, if we're talking about African countries, the countries I know, first of all, if you're talking about politicians, corrupt politicians, I want to argue that there's a very fine line between politicians who are sitting in offices and what you're calling private people who are really the arms of the politicians, in the sense that everything they do rely on government privileges. They have privileged access, monopoly powers in what they do. They pay no debt, no taxes. So even if they have no official positions, private operators who use their privileged relationship with politicians actually cannot really be called private, and that's why what would make it difficult to distinguish between corrupt capital flight and money that has fled the country by which belongs to honest private operators who simply feel that the environment, the domestic environment, is not conducive for investment. I'm not saying it is not possible, but I'm saying that first of all, for a massive amount of money to be leaving the continent has to do with failed regulation, complicity between private and political actors, so that really you can't distinguish. It's very hard to disentangle between what is private, what is political, what is political operators. The other thing is that, as I explained in the presentation, to me it's very hard to find evidence of capital flight which is licit or legitimate. First of all, as I said, capital flight means capital which left the country undocumented and is still undocumented where it is. So explain to me why that would be legitimate. First of all, if the money was acquired legitimately and the investor or the owner felt that they would be better off investing abroad, which is legitimate, then legitimately they would have registered the investment with the government, which all investors do. I mean, if you look at across Africa now, there are huge intra-Africa investments. Nigerian banks investing, branching out in other countries. South African brewery companies, even grocery companies, banks, telephone companies. These are South African, Nigerian, Kenyan investors who are investing abroad. So that's capital, Kenyan capital going to Burundi, Kenyan capital, that's recorded. That's what I call honest capital, flowing from Kenya to Burundi, Uganda, flowing from South Africa to Zimbabwe, Zambia, and so on. The capital that's not recorded, I am hard pressed to understand why we would call it licit or legitimate. And even if it was acquired legitimately and it broke the law by not being recorded during the transfer, it should be recorded, it should be reported where it is held, so that if there is interest being earned, that interest should be taxed as it is taxed when the profit is earned domestically. So I have been thinking about this for many times, many years, because I get this question over and over again: is there capital flight that's legitimate? I haven't found it.
Okay. And this kind of dovetails with a previous answer, is what sorts of organizations, African organizations specifically, by which African countries can face these challenges of illicit capital flight?
Do you mean institutions that can help African countries track down or claim the stolen asset through capital flight?
I think the question, the implication is that if the banks are somewhat complicit in these things, what sort of African-based organizations can help with this, the transparency and the accountability aspect?
Okay, thank you very much. Once again, but to clarify, first of all, as far as the bank's responsibility, as I indicated, this is something that debt audit would establish. You can't presume that bank A is complicit, donor A is complicit or guilty. You have to establish based on explicit debt audit. In terms of institutions that can help African countries, today actually we have seen this debate on capital flight has taken up, has gone up in terms of visibility, political buy-in. The United Nations Economic Commission for Africa, based in Ethiopia, launched in February a high-level panel on illicit financial flows, which is chaired by former President Thabo Mbeki of South Africa, and includes a very high-level dignitaries, personalities from former leaders in the private sector, in the public sector. It's supported by a technical committee. I'm a member of the technical committee, and the role of the high-level panel is to really mobilize the debate around illicit financial flows from African countries. How much the capital flight has fled the continent, through what channels, which countries are most affected, and what can be done. Where is this money started, and who can help? What kind of partnerships can Africa forge to track down the illicit financial flows and help repatriating capital flight? The African Union has been championing rules about combating corruption, and combating corruption is one important piece of this effort to fight against corruption. So I think at the Pan-African level, the attention is rising in terms of the need to stop to stem no, you want to stop capital flight, but at least you can reduce it as part of the broader debate about mobilizing more financing for African development first, but also combating corruption to increase governance in African countries.
Thank you, Doctor. Another question. And I'm going to paraphrase a bit, so forgive me, Dr. Baker, the person that submitted the question. The USA is currently about 16 trillion in debt, and countries around the world have similar economic problems. This is kind of leading to a growing movement to be a little more isolationist and end some of the aid to Africa. Do you see that these sorts of movements impacting sub-Saharan Africa? I mean, is this going to reduce the capital flight, or you think this is going to exacerbate the problem?
Thank you very much. Yes, I think it's now we are in election year, so these issues of debt, U.S. debt, are very much in the news and also in the even academic debates. I talk about this a lot in my classes. I teach macroeconomics. First of all, from an economics perspective, government debt is part of normal business. So, in fact, economists will tell you that it's actually not optimal for a government to have a zero debt. That would be a really bad idea, because debt is one of the biggest instrument in the financial market that is used as a benchmark. But of course, you get concerned when debt starts increasing at high level. But it is to me a normal situation to have debt increasing during a period of recession and post-recession recovery. The government has to take a lead in promoting domestic demand, domestic expenditures, with the view that helps also establish a basis for private sector investment and private sector development. So, if the government had taken a back seat and say, oh no, we want to keep our budget balanced, there's not increased spending, we would be deep in a deeper recession. I think this debt is one of the costs of government leadership. There is nothing free in our world, but if to the extent that the expenditures are targeted to employment creating activities, to the effect that the government is supporting sectors that are creating jobs, this is a very sound policy in a period of post-recession recovery. Of course, there is a concern that the weakness of fiscal balances in developed countries makes it more difficult for donors to allocate more aid to developing countries. We haven't seen much in terms of reduction in aid, big volumes of being cut, but what we are concerned about is delays in disbursements. We believe that in terms of political will, at least not believe, what I see in terms of political will, declared political will among donor countries, the US and other countries, we haven't seen any backtracking in terms of the will to support African countries. So there may not be a major increases in aid, but I still hope that there will not be a reduction in aid. What will be the impact on capital flight? My hope is that with this debate about debt, taxation, and so on, especially in the US, this is helping to actually promote the efforts towards more transparency in the international financial system. A more transparent international financial system would mean less tax evasion, less tax avoidance for the US, and that would mean also less possibilities for Africans to hide money, to transfer money abroad illicitly. So I think this would help the African cause.
In a related question, do you think that monies from foreign governments paying for specifically for military leases, like the U.S. paying for leasing Camp Lemonnier up in Djibouti, are these also part of capital flight, or do you consider them separately?
You mean when the U.S. pays, expenditures related to the U.S. base in Djibouti?
Yes, and other and similar type leases.
I would not say I would not think so, because these are these are identifiable expenditure services in identifiable locations. So I wouldn't think that that would be a major source, any source of capital flight.
Okay, so as long as it's on the books, you're not counting that.
No,
Okay, one
as long as
last
they are identified, yes.
okay, one last question for you, sir. What constructive steps do you think are the most critical to generating a positive cycle of capital accumulation in Africa?
Um, that's a very important question in the sense that positive capital accumulation in Africa is a very important precondition for accelerating growth, which we need for you to reduce poverty, for you to see any positive impact and sustainable impact on poverty reduction. You need to see growth accelerating and being maintained. And a condition for that, one of the conditions for that, is accelerated capital accumulation in Africa. The one of the reasons why there are many reasons why capital accumulation has been low in African countries compared to countries of similar levels of development. One is low, ineffective mobilization of domestic savings. In many African countries, most people think that African countries are poor, households are poor, therefore there is no savings. That's actually not correct, because when countries have undertaken, either private sector or government sector, undertake the targeted initiatives to mobilize savings, we have been surprised about how much savings was lying out there. I give you an example. Even during the crisis in Kenya, the central bank and the Ministry of Finance floated an infrastructure bond, domestic. So it was open only to was subscribed only in Kenyan shillings. It was oversubscribed. They generated more money than they had requested. There was a company that was an IPO of a mobile company that was at the Kenyan Nairobi Stock Exchange, again oversubscribed, domestic, which means that what we are facing here is financial systems in Africa have not reached their optimal level of efficiency in mobilizing domestic savings. In fact, with my colleagues from Burundi, we just published an NBR working paper on the financial sector in Burundi. It's the same thing. We have banks are not doing enough to mobilize savings, and maybe it's not the role of the banks. We need to figure out whether there are other alternative financial institutions that are more tailored, more able to mobilize these domestic savings. The second is that we tend to think about domestic financing as foreign direct investment aid and so on, but what we don't realize is that, in fact, the biggest source of financing in African countries of government programs is public finance. It's taxes, and yet we see that governments are not mobilizing their optimal amount of taxes. The tax GDP ratio is much lower, so which means that governments can do much more in mobilizing revenue domestically, which would support public investment. Because for you to increase capital accumulation, it has to be both private and public, and in many times public investment is going to have to be scaled up much faster for you to get private investment to increase. Certainly you need roads, you need electricity, for you to encourage private sector to invest. And at the same time, we see that there are opportunities for tax mobilization which are not tapped. There are certain there are important sources of taxes which are not tapped. For example, real estate, urban real estate in most African countries is severely under tapped. There are opportunities for PPPs, public sector, public-private sector partnerships to undertake large investment programs. So, and you have heard me talking about only what can be done domestically. And I think before African countries, even as African countries think about how to make their investment, their environment more attractive to foreign direct investment, that should only be a complement to what they can do domestically.